Thank you so much for the chance. Let me see. My technology skills are going to help me again. Can you see it now?
We're good.
Yep, we can see him. So before you start, what kind of feedback are you looking for on your pitch as you practice it?
Yeah, today, thank you so much again, Corey, Connor, and Joseph for inviting me. This is my last deal that they were brainstorming with me and telling me how I can turn this to a case study. So it's gonna be to number one, everybody who has been here in the calls to introduce myself, where I am, what I'm doing. It's a case study, so I'm not pitching anything. I'm not raising capital. I'm not looking for anything, just a feedback as a case study. And at the end, I'll be happy to answer any questions, see if that format works for you guys. Perfect. Okay. So welcome again. My name is Alberto. I'm located in Houston, Texas, and this is my last deal that we closed in March of 2025. So I'm gonna go over a few slides to introduce myself, my business, what I'm doing. Looking forward to open questions and network with anybody who's interested on my self-storage case. So this is how I've been talking to investors and anybody who works with me on this type of projects. We have been having track record over 11 years, how to double the money in 5 years. So you see it now? Okay.
Yeah.
So this is
Yeah,
how perfect. The investors work with me with predictable cash flow. They have equity. They don't have to lose the access to their capital, which is the traditional accounts, and then totally independent of the market crashes. So we're gonna learn today is number one, why self-storage is one of the only investments that make money during recessions. Number two, how low operating costs from my target, which are off-market deals, can generate 200 or more percent ROI on average. The holding time is usually 5 years. And how to invest with low risk in self-storage to receive both cash flow and equity. Okay, moving along. All right. So this is my niche, self-storage owner operator since 2014. As I mentioned, my value add business is targeting properties in my local market here in Houston. And that's how I was able to, I'm gonna tell you more, a little about my story. After I was laid off, I was able to grow from single family homes into 500 doors in 18 months with an approximately market value of $6.5 million. Okay, I think the slides are not moving along. Why this is important for you now? So this has nothing to do with stock market. Some people, the typical landlord with tenant trash and toilets or some other online training courses that they're not really enough to teach you how to take financial independence. So if you're like me, most people, when they're asking for investing in financing, they talk to financial advisors or they watch videos online, they buy training courses online. So this is kind of, you don't know where to go, what's the path going forward. And that's exactly what I like to do when people like to go into business with me and my team. So you ask yourself why this applied to me. And normally that's what I tell people to make sure it's a good match with my investors, asking if this is for you. If my investors are looking to take back control of their money, looking for a plan that offers freedom, this is for you. If they want to protect their money from rising taxes and peace of mind, just a simple plan, this is exactly what I do for them. And if you're tired of looking for a safe, proven strategy that has been time tested, in my case, almost 11 years since I started over here in my market, this is for you. So it has nothing to do get rich quick, no training courses, nothing on the stock market. I know some people make really good returns over here in this group, but that's not my specialty with the hard assets. And most people have been misled to the financial rat race. So I'm originally from Venezuela, moved to Houston in 1999, usually on the oil and gas and petrochemical industry for over 2 decades. So that was a picture of me without the gray hair that I have right now, working 100+ hours, having good income and everything for my family. But until, like many people in this call, 2008, a great financial crisis, I lost half of my 401k retirement in just a few months after saving for a lot of time. And not long after that, 2010, I was laid off and I lost my executive oil and gas job. So after that, I had like not much income coming in into back then I was doing single family home rentals, fixing for lease and no connection reputation, no passive income. And then I had to have some legal issues with some not very ethical loan sharks. At one point, I had $2.5 million in business debt. So it was really, really difficult. But when you stay on track, good things happen. And that's exactly when my turning point came on. So I put my head down, concentrated only on self-storage, not looking around at the shiny object. Some people have too many choices. I just put my head down, just follow one path. And that's how I was able to transition from a single family home landlord, having a portfolio here in Houston on usually value add, buying foreclosures under market value and renting fixed for lease for cash flow. So I switched to self-storage 2014. And that's what I've been doing with my group of investors, offering predictable cash flow and upside equity potential. So you're asking yourself, why self-storage? So this is a picture of the property we're going to talk about today. People use self-storage when life changes happen, moving, downsizing, running a small business, equipment, trucks, trailers. And this need doesn't go away even when the economy goes up and down. So self-storage tend to stay very stable even during downturns, even during some storms over here in Houston. For me, it's about finding predictable, steady income rather than chasing risky trends. So this is in a nutshell the 3 steps of my value add strategy. Number one, finding the off-market deals. Number two, improving operations. And number three, increasing the NOI. NOI stands for net operating income, so I can generate more cash flow in distributions for my investors. So finding the deals, I target off-market facilities, as I mentioned. They usually are mom and pop, a good location. They have not much of a marketing system professional, and that creates opportunity to buy a reasonable price. It's a good offer for the seller. It's a good offer for us coming to improve the efficiencies. So that takes to step number two, improving operations. So most of these mom and pop, they don't have professional management. Sometimes they don't have even automated locks or gates for entering the facilities. Sometimes they don't even answer the call when people, believe it or not, even technology right now, people like to phone call and then having a U-Haul truck or just move me because all the logistics involved, especially residential uses for self-storage. They don't understand the dynamic pricing, which is art and a science on your competition locally in a 1, 3, and 5 mile radius. And then do better marketing so units don't stay empty because empty units don't generate any profits. Number three is how we grow the NOI, which stands for net operating income. Again, this is a subject property that I want to share more details with you in a minute. So as we increase the NOI, the income pretty much is basically NOI equals the income minus the operating expenses. So the higher that we can start filling more empty units, or in some cases, like in this case, we add more buildings, the NOI goes up. And when the NOI grows, the property value grows too. So that is the true engine of the wealth creation and self-storage, creating predictable cash flow and equity upside. Inside these 3 steps in finding the deal, some of the criteria using for underwriting is I prefer off-market. Very few options. I work with pocket listings, some brokers that I pre-selected and I already know them for more than 10 years. I like to see a local demand of under 10 square feet per capita, meaning for every person in my target market, there's a 10 square feet of demand or lower. The rental rates in the 1 3 mile radius, we can go over another day. That's a lot of data. This is just for example purposes only. I'm looking for economic vacancies, meaning the subject property is charging less than the average of the maximal potential on that subject market. Number 3 has expansion opportunities. Sometimes they have empty space, could be parking, could be adding more buildings, or in some other cases, a combination of both. And most likely, some of these are not managed professional. On the second step, improving operations, as I mentioned before, technology, marketing, call center, revenue management. Sometimes they have people, like in this case, these last properties, people don't pay for more than months. And it's a very, very complicated case. It's much faster than the traditional eviction on single family homes and multifamily. Here, the process is simple, but it's still, it has to be done properly. So it's a good protection for the owner or the management company if that's the route, making sure you're following all the legal sequence on each state. Some states are different than others. Here in Texas is very simple. Then we do online marketing, capturing all those leads that the mom and pop, because they sometimes don't even have a website. People don't know this facility is available. And of course, automated bookkeeping for KPIs and professional reporting to our partners and everybody involved in each project. And then this is when the fun begins, usually between 6 months to the first 9 months on the year of acquisition. We start improving the NOI as we're doing right now with this particular property. So we have new leads coming from the website. We have now rental rate increases that in some cases, the sellers don't do it in sometimes years because they don't know what they don't know. They don't have enough security cameras giving protection, safety for the tenants. And again, some mobile cell phone-based technologies to have access to facilities. So this is just in a nutshell what I was putting in my OM on this deal is 346 doors. It's a combination of non-climate units, 235, one warehouse, 70 covered parking, and 40 open parking lot, which we're now turning into covered parking so we can charge double. Acquisition price was $3.25 million in the US, and we did it through a seller financing at attractive interest rate and 5-year balloon, one potential extension. And again, that's a long story. I can share more during the Q&A at the end. So we're offering our investors a 2.3 equity multiple in 6 years old. So each dollar coming in is going to turn into $2.3 on your exit. And this is the breakdown of the down payment that we did, some other additional costs for the expansion, reserve, operating expenses. So that's going to generate 9% cash on cash, 26%, 26.5 almost an average annual return. And that's a 19% return of rate of return, IRR. So picture is 1,000 words. So imagine your investors putting on this deal $50,000. In this case, we have two type of shares. This is people looking for cash flow. So it's very simple, very predictable. What we're offering here is 6% preferred return. So over the 6 years of holding, 50,000 generates 30,000 that we do distributions quarterly. And then at the end, in 6 years, you're going to get a capital back. So 50,000 multiplied for the 1.6 equity multiple gives you 80,000. And the same goes for 100,000 multiplied with 1.6. So you get 60,000 on the preferred return. And these are paid before everybody else. That's why it's a priority on cash flow. The other ones are people looking for growth, which is more attractive. They're going to be getting paid after the Class A shares. So this is a higher equity multiple, 2.3. In this case, they get paid two ways. They get paid 7% preferred return after the Class A are paid. And in addition to that, they have operation distributions and the equity participation at exit. In this case, is 41,000. Returning the capital, so the same formula applies, 50,000 times 2.3 equity multiple equals 118,000. For 100,000, it's very simple math, is 237,000. So these are the pictures of the property. It's pretty large. Total of property is almost 13 acres, and there's 4 acres included on the purchase price for expansion. So all these are single, non-climate, very simple buildings, and this is the back section, a lot of the RVs and boats, and this is where we put in right now the covered parking so we can double the rental rates as we finish the expansion in the next few weeks. So this is a air view from the property. This is the main entrance. This is the current section, 8.5, almost 9 acres, and this is the 4 acres for expansion. This is Interstate 69 that takes you all the way. This is South Texas. Over here is Boca Chica, the launching facility for SpaceX. So this is a nice demographic of some medical university, and over here is Sal Padre Island, one of the best attractions on tourism, especially for spring break and summer. So there's a lot of people needing the boats and RV all the time in these locations. So these are the lessons learned. Number one, change doesn't happen overnight. It takes months to increase revenue and lower the cost at the same time, which is what we're doing as we finish more than 6 months under the new management. Number two, expansion projects require careful budgeting and oversight. In this case, we had some pretty bad weather, as you guys know, in Texas, in addition to some delays on the permit. So that basically delayed for almost 2 months to just get started on the covered parking. Three, professional storage management is the difference that really makes a good property into a great one. Why is the best time, in my opinion, to invest in self-storage right now? Let's share some data. Number one, there's an occupancy recovery in the overall self-storage industry. Occupancy is on the uptrend right now, and that is also in addition to slower new supply, meaning constructions being delayed, and the interest rate is also helping us. Let's talk about the first one, occupancy recovery and slower new supply. What that means is the slower supply is less competition coming in. For example, like in this market, which is in the Rio Grande Valley. So existing operators can recover occupancy faster than people that's still in the process of permits and new construction. Regional pockets in the Midwest, like here in Texas and also in the Sun Belt, allow selective value add to outperform acquiring in markets where absorption is the strongest, meaning where's a high demand, like I told you, that underwriting criteria of the 10 square feet per capita, that guarantees you there's going to be enough demand after you close the acquisition. The absorption is how fast you can start increasing your occupancy after you close and take over. And then institutional interest still there, so they're not going anywhere. Fundamentals are still strong in the self-storage industry. The interest rates cut is also helping because nobody knows exactly what's going to happen. But just as a question here, imagine 40-50% drop of 40 basis points on the interest rate is actually going to help increase the valuation of this type of property. Number one is cheaper debt. Right now, the interest rates on the debt for self-storage is about the same. In the US over here is changing faster and going low for the residential rather than commercial. But I'm pretty sure it's going to change probably next quarter. Cap rates are actually compression coming back down, so they work opposite way, the valuation increasing the market values of the properties. And then number three, you have access to low construction costs. Like in this case, anytime you have additional land for expansion, you're gonna start adding more units, more rentable space, and at the end of the day, that increases the NOI, increases the cash flow, increases the distributions for all the investors participating with my team. So my goal today is sharing, not to pitch you anything, just how I work. I believe trust comes from being open about the process. And yes, there's always risk involved, but as long as you minimize that and you identify what's the best strategy for maximizing the occupancy and the NOI, the chances of being predictable cash flow are very high. So if you walk away from this with a clear understanding of what self-storage is, then I achieve my goal. And then this is one of my team's QR code in case you want to get in touch with me, or we can do it through Corey or Joseph. 832-919-6080. So open up for questions.
Yeah, if
That's
anybody
great, Alberto.
has questions about the deal or feedback on how, if you think it can be delivered in a different way that might be more effective, Jerry.
So I'm just curious. Because obviously, how do you look at occupancy when it comes for these things? Like, I hear all the stuff. I mean, obviously, you went from single family home, and we talk about multifamily, and then in there storage. So how do you go about knowing if a particular property, number of doors, and the occupancy? Because isn't that a little bit volatile? Like, how do you pick which storage unit? You pick that as a multifamily asset to go into, but how do you maintain or structure where you have all your units rentable and profitable?
One of the
How do
reasons
you
why, good question. One of the reasons why I switched to self-storage back in 2014, and I still have some rentals doing well, but I was very happy when I saw every single one of them. There's no tenants, no trash, no toilets. Here, the occupancy is more controllable because you have a month-to-month rent. This is not a year renewal like you do in single family homes or multifamily. You don't have to wait 1 year to renew. This is month to month. And if you do a combination of the competition in the 1, 3, 5 mile radius, and usually just like multifamily is dollars per square feet. So you stay a value add. You offer good quality service, not at the highest rental rate, just little under, right?
Mhm.
So they prefer to come into you instead of, for example, all the big REITs like the U-Haul, CubeSmart, Green Doors, Orange Doors, depending on what city where you are located. But in
So
terms of, go ahead.
no, go ahead. Sorry.
That's the occupancy. In terms of the selection, it's a long list to select where and what kind of asset I'm looking for. But in long story short, is a value add where it's not managed professional. And then after I come in with my team, we can increase rent, give better service, keep people happy. And normally you'll be surprised. In some cases, I have sellers that they had on a small property, $100. They have 12 units for the family, not collecting rent. That's 10% of your revenue.
Yeah, so that's what I mean. I look at storage and I'm like, man, okay, there's so many different ways storage. You have those big buildings, which, and then you have the flat format that you just showed us in that picture. Like, how do you keep? I mean, are people really storing that much stuff? And then how do you keep track of who's paying and how they're paying? And if they don't pay, what do you do? Like, the
There
work kind of.
management softwares for managing this, just like any other asset class. And in some cases, you can do it from your cell phone. In my case, I'm using now professional management. I'm not owner operator anymore because you don't see on the camera, but I lost a lot of hair doing myself. But you'll be
I can only
surprised.
imagine.
If you do a good service at a decent rental rate, people stay for years.
Wow.
Mhm.
And then what's the cost if somebody's not paying? Like, because I've seen where storage, people get their thing repositioned. Obviously, you see those TVs where, storage kings or whatever. These guys own these things and people don't pay. They lock up
That's
the
a
thing. And
show. You're not gonna find like a Rolex watch and something a
right,
diamond,
right. But
right?
still, the cost to go get that, close it because somebody hasn't paid for 6 months, and then you have to get legal. Like, how's the cost on those? Like, what's your expenses pretty much? Like, somebody doesn't pay. How do you maintain that?
I can tell you it's faster and cheaper than any other asset class because there's no tenant, nobody's
Uh-huh.
living there. You overlock. Each state is different. I only operate in my local market in Texas.
Yeah.
But here is a very simple process that the contract dictates, just like single family homes and multifamily, what's the terms and conditions. Once they don't pay, you put an overlock. They cannot cut. If they cut the lock, that's a felony. You could take them to court, so people don't do that. And then after is logged, you send a certified letter for delinquency and you give them a window of time. And then you do a second certified letter. If they don't respond, you cut the log, you take pictures, put the unit for auction, and then your rent ready is a blower. You clean out all the bugs and the spider webs, and you rent in the same day to somebody else. You don't have to change carpet, you don't have to paint, you don't have to fix toilets. It's a different model, but that's one of the, for me, the attractions is predictable. Nobody's living there. There's no plumbing, there's no electricity. Only on the climate control units, you have a little more maintenance, but
Yeah.
it's a warehouse. It's very
So it's a
simple.
quick turnaround.
Correct. Good question.
So, and
So,
that with that asset. Oh, sorry. I'm so curious.
I'm
because
sorry,
like,
Gary. We just have a few people that have some more questions.
Yeah, go ahead.
Sushami?
Thank you, Corey. Good questions. We can connect later, Jerry.
Hi, Alberto. I have some investors. They are curious because they want to reduce their tax. How much depreciation they can get if, for example, if they put like 100,000 to invest?
That's a really good question. Yes, right now I identify right here in my local market a cost segregation company that is specialized on self-storage. The savings are significant. We can meet privately to discuss depending on how much you and your investors are going to do. It's similar to other commercial real estate deals where the cost segregation is now 100% bonus depreciation. So as we enter class A or B, both are equity, you receive a lot of the tax credit back. Yes.
Thanks for checking out the video. We just heard from Alberto discussing investing in self-storage and all the benefits of that resilient asset class. If you want to see more videos like this, check out our channel. If you want to catch the call and participate in the conversation, it's every Wednesday night, 7:30 p.m. Come check us out. We're the deal room practicing your pitch, and bring your questions. If you're interested in participating in the call and pitching a deal or practicing a presentation, send us a note and we'll get you on the schedule and you can get on and practice your pitch. Like, subscribe, drop a comment. Thanks for watching.